the electricity nobody sees. This is story behind stocks, where the biggest opportunities are sometimes hidden inside the infrastructure nobody notices. Imagine waking up tomorrow to a world where artificial intelligence has become even more powerful. More people are using AI. More businesses are moving their operations to the cloud. More companies are building massive data centers. More factories are becoming automated. And more machines are beginning to make decisions that once required human beings. It sounds like a technology story. But underneath all of it is a much simpler requirement. Electricity. Because every artificial intelligence model needs servers. Every server needs electricity. Every data center needs electricity. And when thousands, sometimes hundreds of thousands, of powerful computing machines operate together, electricity is no longer just an input. It becomes the foundation. And this creates a fascinating problem. The world may be entering a period where the ability to generate reliable electricity becomes just as important as the ability to process information. Think about what that means. For decades, investors have focused on the companies building the visible part of technological change. The chip manufacturers, the software companies, the cloud platforms, the artificial intelligence companies. But behind every one of those businesses is an invisible infrastructure. Power generation, transmission, cooling, backup systems, electrical equipment, machines that most people never think about. And somewhere inside this invisible layer sits an Indian company that doesn't make artificial intelligence software, doesn't manufacture computer processors, and doesn't own data centers. It makes generators and electrical machines. Its name is TD Power Systems. And at first glance, TD Power may look like a fairly traditional industrial company. It manufactures equipment. It operates factories. It supplies generators. It serves industrial customers. There is nothing particularly glamorous about that description. But sometimes the most interesting investment stories begin precisely this way. A company appears ordinary until the world around it changes. Because when the demand for electricity starts accelerating, the machines that produce and manage that electricity become increasingly important. And TD Power is positioned somewhere inside that chain. The company manufactures generators used across several applications: steam power, gas power, hydropower, industrial facilities, specialized applications, and increasingly, power infrastructure associated with data centers and large global equipment manufacturers. But there is an important distinction here. TD Power is not betting everything on artificial intelligence. And that may actually be one of the most interesting aspects of the story. If artificial intelligence demand slows, TD Power still has industrial customers. If one power generation technology becomes less attractive, TD Power has multiple generator categories. If one geography slows down, the company has a growing international presence. So the story is broader than one fashionable theme. The deeper story is about electricity itself. The world is becoming increasingly dependent on reliable power, and that dependence is spreading across industries. Factories need it. Hospitals need it. Data centers need it. Transportation systems increasingly need it. Digital infrastructure needs it. And as economies become more electrified, the consequences of a power shortage become increasingly expensive. That changes the value of reliability. A company running a small office may tolerate a short power interruption. A massive data center cannot operate on that assumption. A factory running sophisticated equipment cannot simply stop production every time the electricity supply becomes unstable. A large industrial facility needs dependable power. And that is where generators become much more than machines. They become insurance against interruption. That is the first clue in the TD Power story. The company operates in a part of the economy that most people don't notice until something goes wrong. And businesses that operate behind the scenes can sometimes become surprisingly valuable when the world suddenly needs more of what they produce. But there is another reason this company deserves attention. TD Power has spent decades building engineering capabilities, manufacturing knowledge, and relationships with international customers. That matters because generators are not like ordinary consumer products. A customer doesn't simply choose one because it looks better or costs slightly less. The equipment has to meet precise technical requirements. It has to integrate with the customer's system. It has to perform reliably. And in many applications, failure is not merely inconvenient. It can be extremely expensive. That creates a natural barrier. A new competitor cannot simply build a factory and expect a global customer to immediately trust its equipment in a critical power application. It has to prove itself. It has to qualify its products. It has to build engineering expertise. It has to develop customer relationships. It has to demonstrate reliability. And that takes time. This is one of the hidden reasons why TD Power's history matters. The company has built its capabilities over many years, expanding its technology relationships, manufacturing footprint, and international customer base. Its presentation describes a journey from its early manufacturing operations to a business supplying products across more than 100 countries. So when we look at TD Power today, we shouldn't see only a manufacturer selling generators. We should see a company with accumulated engineering knowledge sitting inside a world that may require substantially more power infrastructure. And that leads to the central question of this entire documentary. Is TD Power simply a well-run industrial company benefiting from a favorable cycle? Or is something much bigger happening? Could the growth in electricity demand, the rise of data centers, global industrial investment, and increasing demand for reliable power be creating an opportunity that is larger than the company's traditional market? Because if that is happening, then the most important thing about TD Power may not be what it has already achieved. It may be what its existing capabilities allow it to become. And that is where our story really begins. Because before we can understand why TD Power could become a bigger company, we need to understand something much larger than TD Power itself. We need to understand why the world is suddenly becoming much more hungry for electricity. And once we follow that electricity trail, the connection between artificial intelligence, data centers, industrialization, and a seemingly ordinary generator manufacturer becomes far more difficult to ignore. The company behind the current. This is story behind stocks, where the real value of a company often lies not in what it sells, but in what its customers cannot afford to get wrong. If you are asked to describe TD Power Systems in one sentence, you might say it is a company that manufactures generators and electric motors. Technically, that would be correct. But it would also miss the most important part of the story. Because a generator is not simply a machine that produces electricity. It is the final link between mechanical energy and electrical power. Imagine a turbine spinning inside a power plant. The turbine is producing mechanical movement. The generator takes that movement and converts it into electricity. That electricity can then travel into a factory, an industrial facility, a power grid, or another critical application. So when TD Power sells a generator, it is not really selling a piece of machinery in isolation. It is selling a machine that has to perform reliably inside somebody else's much larger system. And that changes the nature of the business. A customer buying a large generator isn't looking only at the purchase price. They are thinking about reliability, efficiency, engineering compatibility, delivery, maintenance, and most importantly, what happens if the machine fails. For a large industrial customer, a generator failure can interrupt production. For a power generation project, it can delay commissioning. For a critical infrastructure application, downtime can become extremely expensive. That is why this industry has an unusual characteristic. The customer may spend a significant amount of money buying the equipment, but the real value is often created over the many years during which that equipment continues operating. This is why engineering credibility matters. And this is where TD Power's history becomes important. The company has developed capabilities across several types of generators. It manufactures equipment for steam turbine applications. It participates in gas turbine generation. It supplies generators for gas engines. It manufactures hydro generators. It also produces machines for specialized applications. And its products are used across industrial and energy sectors. This breadth matters because electricity does not come from one source. Different customers need different machines. A hydro project has different requirements from a gas turbine project. A captive industrial power plant has different requirements from a data center application. A locomotive or marine application has different requirements again. TD Power's ability to operate across these applications gives it multiple avenues of growth. But the more interesting question is how the company got here. TD Power's story is not a recent one. The company has spent decades building its manufacturing and engineering capabilities. Its history includes technology collaborations and the gradual development of its own product and manufacturing capabilities. Over time, the company expanded beyond its original base and developed an international customer footprint. Its presentation describes products supplied across more than 100 countries and a cumulative installed base running into thousands of generators. That number tells us something that a normal revenue figure doesn't. TD Power's machines are operating in many different environments, under different operating conditions, and for different customers. That creates accumulated experience. Every installation adds knowledge. Every customer requirement teaches the engineering organization something. Every successful project strengthens credibility. And every repeat order provides another piece of evidence that the customer trusts the product. This is particularly important in a business where qualification matters. Qualification simply means that a customer has tested and approved a company's product or capability for a particular application. Once a company becomes qualified with a large global customer, replacing it is not always as simple as switching suppliers. The replacement supplier may need to go through its own testing and approval process. That creates a form of business protection. It is not an impenetrable competitive advantage, but it can make relationships more durable. And TD Power has spent years building those relationships. Its management team also reflects this long industrial history. The company's presentation shows senior leaders with decades of experience in rotating electrical machines, power generation, manufacturing, finance, and global sales. That matters because this isn't a management team that suddenly discovered the power equipment opportunity because artificial intelligence became fashionable. They have been operating inside this industry for years. They understand the machines. They understand customers. They understand manufacturing. And they understand the technical requirements that determine whether a generator works reliably in the real world. There is another aspect of the business that deserves attention. TD Power increasingly operates through relationships with large original equipment manufacturers. An original equipment manufacturer, or OEM, is essentially a company that builds or supplies a larger system and uses specialist manufacturers for important components. This can create an interesting business model. TD Power doesn't need to build the entire power plant. It doesn't need to build the entire turbine system. It can become the specialist manufacturer supplying an important component inside a much larger project. And when that larger customer wins more projects, the component supplier can potentially receive more orders. That is exactly the kind of relationship that can create operating leverage over time. The customer brings the global project pipeline. TD Power brings the specialized manufacturing capability. If both sides grow together, the relationship can become increasingly valuable. And this brings us to something many investors may overlook when they look at industrial companies. The factory is visible. The machines are visible. The financial statements are visible. But the invisible network around the factory can be just as important. Engineers who know how to design the machines. And once we follow that electricity trail, the connection between artificial intelligence, data centers, industrialization, and a seemingly ordinary generator manufacturer becomes far more difficult to ignore. The company behind the current. This is story behind stocks, where the real value of a company often lies not in what it sells, but in what its customers cannot afford to get wrong. If you were asked to describe TD Power Systems in one sentence, you might say it is a company that manufactures generators and electric motors. Technically, that would be correct. But it would also miss the most important part of the story. Because a generator is not simply a machine that produces electricity. It is the final link between mechanical energy and electrical power. Imagine a turbine spinning inside a power plant. The turbine is producing mechanical movement. The generator takes that movement and converts it into electricity. That electricity can then travel into a factory, an industrial facility, a power grid, or another critical application. So when TD Power sells a generator, it is not really selling a piece of machinery in isolation. It is selling a machine that has to perform reliably inside somebody else's much larger system. And that changes the nature of the business. A customer buying a large generator isn't looking only at the purchase price. They are thinking about reliability, efficiency, engineering compatibility, delivery, maintenance, and most importantly, what happens if the machine fails. For a large industrial customer, a generator failure can interrupt production. For a power generation project, it can delay commissioning. For a critical infrastructure application, downtime can become extremely expensive. That is why this industry has an unusual characteristic. The customer may spend a significant amount of money buying the equipment, but the real value is often created over the many years during which that equipment continues operating. This is why engineering credibility matters. And this is where TD Power's history becomes important. The company has developed capabilities across several types of generators. It manufactures equipment for steam turbine applications. It participates in gas turbine generation. It supplies generators for gas engines. It manufactures hydro generators. It also produces machines for specialized applications. And its products are used across industrial and energy sectors. This breadth matters because electricity does not come from one source. Different customers need different machines. A hydro project has different requirements from a gas turbine project. A captive industrial power plant has different requirements from a data center application. A locomotive or marine application has different requirements again. TD Power's ability to operate across these applications gives it multiple avenues of growth. But the more interesting question is how the company got here. TD Power's story is not a recent one. The company has spent decades building its manufacturing and engineering capabilities. Its history includes technology collaborations and the gradual development of its own product and manufacturing capabilities. Over time, the company expanded beyond its original base and developed an international customer footprint. Its presentation describes products supplied across more than 100 countries and a cumulative installed base running into thousands of generators. That number tells us something that a normal revenue figure doesn't. TD Power's machines are operating in many different environments, under different operating conditions, and for different customers. That creates accumulated experience. Every installation adds knowledge. Every customer requirement teaches the engineering organization something. Every successful project strengthens credibility. And every repeat order provides another piece of evidence that the customer trusts the product. This is particularly important in a business where qualification matters. Qualification simply means that a customer has tested and approved a company's product or capability for a particular application. Once a company becomes qualified with a large global customer, replacing it is not always as simple as switching suppliers. The replacement supplier may need to go through its own testing and approval process. That creates a form of business protection. It is not an impenetrable competitive advantage, but it can make relationships more durable. And TD Power has spent years building those relationships. Its management team also reflects this long industrial history. The company's presentation shows senior leaders with decades of experience in rotating electrical machines, power generation, manufacturing, finance, and global sales. That matters because this isn't a management team that suddenly discovered the power equipment opportunity because artificial intelligence became fashionable. They have been operating inside this industry for years. They understand the machines. They understand customers. They understand manufacturing. And they understand the technical requirements that determine whether a generator works reliably in the real world. There is another aspect of the business that deserves attention. TD Power increasingly operates through relationships with large original equipment manufacturers. An original equipment manufacturer, or OEM, is essentially a company that builds or supplies a larger system and uses specialist manufacturers for important components. This can create an interesting business model. TD Power doesn't need to build the entire power plant. It doesn't need to build the entire turbine system. It can become the specialist manufacturer supplying an important component inside a much larger project. And when that larger customer wins more projects, the component supplier can potentially receive more orders. That is exactly the kind of relationship that can create operating leverage over time. The customer brings the global project pipeline. TD Power brings the specialized manufacturing capability. If both sides grow together, the relationship can become increasingly valuable. And this brings us to something many investors may overlook when they look at industrial companies. The factory is visible. The machines are visible. The financial statements are visible. But the invisible network around the factory can be just as important. Engineers who know how to design the machines. Employees who know how to manufacture them. Customers who know the company. OEMs that have already qualified its products. Suppliers that understand its requirements. International teams that know how to execute projects. All of these capabilities have been accumulated over time. They don't appear neatly as a single line item on the balance sheet. But they can determine how quickly a company is able to respond when demand suddenly increases. And this is where TD Power's story starts becoming more interesting. Because the company already has something that many new entrants would struggle to build quickly. It has manufacturing capability. It has engineering experience. It has international customers. It has a broad product portfolio. And it has relationships with global equipment manufacturers. The question now is whether the world is entering a period where those capabilities become much more valuable. Because if electricity demand was growing slowly and power infrastructure investment remained stable, TD Power could remain a successful but relatively ordinary engineering company. But something much bigger is happening around it. Artificial intelligence is increasing computing requirements. Data centers are expanding. Industries are becoming more dependent on reliable electricity. Power systems are changing as renewable energy grows. And companies around the world are investing in new generation capacity. Suddenly, the market for a company that knows how to build reliable generators starts looking very different. And this is the point where TD Power's story moves from the company itself to the industry surrounding it. Because the next question is no longer simply, what does TD Power manufacture? The much bigger question is, why might the world need substantially more of what TD Power already knows how to manufacture? And once we follow that question, we arrive at one of the most powerful forces shaping the company's future. The world's growing appetite for electricity. The world is becoming more power hungry. This is Story Behind Stocks, where we connect a company to the forces changing the world long before those changes fully appear in its financial statements. For most of the last few decades, the growth of electricity demand was relatively easy to understand. More people meant more homes. More factories meant more electricity. More businesses meant more offices, machines, and equipment. But something different is happening now. Electricity is becoming the foundation of the digital economy itself. Think about what happens when you ask an artificial intelligence system a question. Behind that simple interaction are powerful computer processors working inside data centers. Those processors consume electricity. The cooling systems consume electricity. The networking equipment consumes electricity. The storage systems consume electricity. And the larger the artificial intelligence models become, the more computing power they require. That means the artificial intelligence revolution is quietly creating another revolution behind it. A power infrastructure revolution. This is where TD Power begins to look very different from the ordinary industrial company we described in the previous chapter. The company does not have to predict which artificial intelligence application will become successful. It does not have to build the winning AI model. It does not have to compete with the world's largest technology companies. Its opportunity sits one step behind all of them. The machines that help generate reliable electricity. And that distinction is extremely important. Because technology trends can change quickly. A particular software platform can disappear. A particular chip architecture can be replaced. A particular artificial intelligence application can become obsolete. But the requirement for electricity remains. And when the physical infrastructure supporting the digital economy becomes larger, the demand for power equipment can increase regardless of which technology company eventually wins. That is the first major tailwind. But it is only the beginning. The world is also becoming increasingly electrified. Factories are becoming more automated. Industrial processes are becoming more dependent on electrical systems. Data centers are expanding. Cloud computing is growing. And companies are increasingly unwilling to tolerate interruptions in their electricity supply. That last point is particularly important. Electricity is no longer simply about how much power is available. It is also about whether that power is available when it is needed. A data center cannot simply shut down because the grid experiences a disruption. A factory cannot casually stop a production line. A critical industrial facility cannot always depend entirely on the public grid. That creates demand for dependable generation equipment. And this is where generators become strategically important. A generator can provide electricity when the main grid is unavailable, insufficient, or unreliable. In some applications, it can also become part of the primary power system itself. So the generator market is connected to a much larger question. How much does reliable electricity matter to the customer? The more expensive an interruption becomes, the more valuable reliable power becomes. And TD Power is increasingly exposed to precisely these applications. Its recent business developments show growing participation in data center-related programs, gas turbine projects, industrial applications, and international power infrastructure. The company has reported repeat orders from global original equipment manufacturers for United States data center applications. That word repeat is important. It means the opportunity is not simply a theoretical connection between AI and generators. There are already customers placing additional orders for equipment associated with this demand. And there is another structural change taking place at the same time. Renewable energy is expanding rapidly across the world. At first, that might seem unrelated to TD Power. But there is an interesting complication. Solar power depends on sunlight. Wind power depends on wind. Electricity demand, however, does not wait for either. People use electricity at night. Factories operate when there is no sunlight. Data centers run continuously. This means power systems have to become more flexible as renewable generation becomes a larger part of the overall electricity mix. There is therefore a growing need for systems that can provide power when renewable generation is not available or when the grid needs additional support. Gas-based generation can play a role here. Hydro can play a role. Other forms of generation can play a role. And TD Power has exposure to several of these areas. That is one reason the company's business model is more interesting than simply calling it a generator manufacturer. It participates in the equipment layer underneath several different power trends. There is another major opportunity: industrialization. When a new factory is built, it needs electricity. When an existing factory expands, it needs more electricity. When an industrial company wants greater control over its power supply, it may invest in captive generation. Captive generation simply means producing electricity for your own industrial facility instead of depending entirely on electricity purchased from the public grid. Again, this creates a potential market for generators. And the global nature of TD Power's business makes the opportunity even broader. India is important, but the company is increasingly participating in markets across the United States, Europe, Africa, and other international regions. That matters because global electricity demand is not driven by one economy. Different regions can be at different stages of their investment cycles. One market may be slowing while another is expanding. A global customer base can therefore provide more opportunities than relying entirely on one domestic cycle. The company's presentation shows an increasingly international order mix, with exports accounting for a very large share of recent order inflow. That is both an opportunity and a warning. The opportunity is obvious. A global market is much larger than a domestic market. But the warning is equally important. Global markets come with global risks. Currency movements matter. Trade policies matter. Geopolitics matter. Customer investment cycles matter. And when a company becomes heavily exposed to international demand, its future is influenced by events happening thousands of kilometers away. So the electricity opportunity is powerful. But it isn't unlimited. There is another factor that could influence the sector. The world's power infrastructure is aging. Some grids were designed for a very different electricity system. They were built when power flowed mainly from large, centralized generation facilities toward consumers. The modern system is becoming more complicated. There is renewable generation, distributed generation, storage, large data centers, electric vehicles, industrial electrification, more sophisticated digital infrastructure. All of this places additional demands on the electricity system. The equipment surrounding generation and transmission therefore becomes increasingly important. And this is where the TD Power story starts becoming larger than the simple question of how many generators the company can sell. The real opportunity is the amount of investment the world may have to make to keep electricity reliable while demand changes. That is a much larger market. But there is one important distinction we need to keep in mind. A large industry does not automatically create large shareholder returns. A company can operate in a massive market and still earn poor returns. Competition can be intense. Customers can have bargaining power. Raw material prices can rise. Manufacturing can become capital intensive. And growth can consume cash. So the real question is not whether the power industry has a tailwind. It clearly does. The real question is whether TD Power has the capabilities to capture that tailwind profitably. And that brings us back to the company. Because TD Power is entering this environment with something that many competitors cannot build overnight. Decades of engineering experience, established manufacturing facilities, global customer relationships, product qualification, technology partnerships, and a growing relationship with some of the world's largest equipment manufacturers. The industry is becoming more power hungry. But the next question is much more difficult. Who actually captures the economic value from that growing demand? Because whenever an industry enters a powerful growth phase, there are always two sides to the story. There are companies that receive more orders. And there are companies that turn those orders into exceptional returns. Understanding the difference between the two is where the next chapter begins. This is Story Behind Stocks, where the real opportunity is not simply finding a growing industry, but discovering which company has the capability to turn that growth into lasting economic value. The tailwind has teeth. This is Story Behind Stocks, where a great opportunity becomes interesting only after we understand what could stop it. It is easy to look at the electricity story and become excited. Artificial intelligence is expanding. Data centers are expanding. Industrial activity is expanding. Power demand is increasing. and TD Power is sitting in the middle of several of these trends. But there's a problem with every powerful industry cycle. When demand becomes strong, everybody sees the opportunity. Customers want more equipment. Manufacturers want more capacity. Suppliers become busier. And suddenly the question changes. It is no longer, can we find customers? It becomes, can we fulfill everything those customers are asking for without damaging the economics of the business? That distinction is extremely important for TD Power today. The company itself says demand remains very strong across all its generator verticals and describes the order pipeline as extremely buoyant. But management also makes a revealing statement. The current rate of order inflow has crossed 700 crore rupees per quarter, and this is putting pressure squarely on execution. At the same time, management believes the company is well positioned to deliver close to that inflow rate. Think about what that means. For many companies, the biggest problem is finding enough orders. For TD Power, the problem is increasingly becoming how quickly it can convert those orders into finished products and revenue. That is a much better problem to have. But it is still a problem. Because a generator cannot be manufactured simply by pressing a button. It requires materials, components, engineering, labor, production capacity, testing, quality control, logistics, and eventually installation or delivery. Every additional order therefore creates additional demands on the organization. And there is another hidden requirement. Cash. When a manufacturer receives more orders, it usually has to spend money before it receives the final payment. It may need to purchase copper and other materials. It may need to build inventory. It may need to pay suppliers. It may need to keep products under production for months. Meanwhile, the customer may pay only after certain milestones are achieved. This is what makes working capital so important. Working capital is simply the money temporarily locked inside the operating cycle of the business. And rapid growth can make that number rise very quickly. This creates one of the most interesting tensions in TD Power's story. The company wants more orders. Investors want more orders. The market celebrates more orders. But too many orders arriving too quickly can place pressure on manufacturing capacity and cash. That is why the quality of growth matters. A company growing revenue by taking on enormous working capital requirements may not create as much shareholder value as the headline growth suggests. But there is another risk hiding inside the sector. Raw materials. Generators contain significant amounts of metals and specialized components. If input prices rise rapidly, manufacturers have to either absorb the increase or pass it on to customers. Passing it on is not always immediate. There can be a time gap between receiving an order and delivering the machine. If costs change during that period, margins can come under pressure. This becomes particularly important when the company is growing rapidly, because investors may look at rising revenue and assume the entire increase will flow through to profit. That does not always happen. A manufacturer has to maintain pricing discipline while managing costs. And then there is the international side of TD Power's opportunity. The company's global presence is one of its strengths. But international business comes with another layer of uncertainty. Currency movements can change the value of revenue and costs. Trade policies can change. Geopolitical conditions can change. Industrial investment can slow in a particular region. A customer may postpone a project. A global original equipment manufacturer may change its production plans. TD Power's presentation itself warns that its forward-looking expectations are exposed to factors including global economic conditions, industry performance, competition, implementation of strategy, technological changes, revenue and cash flow changes, and market risks. That warning is not unusual. Every listed company has one. But in TD Power's case, it is particularly relevant because the company's growth is becoming increasingly international. The latest order inflow illustrates this perfectly. Around 93% of order inflow came from exports. The company received approximately 684 crore rupees of export orders against about 257 crore rupees in the corresponding period. The total order book at the end of June stood at roughly 2,207 crore rupees. This is a remarkable opportunity, but it also tells us something about the company's future exposure. TD Power is increasingly participating in global investment cycles. That means the company can benefit when global power infrastructure spending accelerates. But it also means investors need to watch global demand carefully. And there's another subtle risk: customer concentration. TD Power is winning increasingly significant programs from major global equipment manufacturers. That is positive because these customers can potentially generate large repeat orders. But large customers also have negotiating power. A delay from one major program can affect the timing of revenue. A change in a customer's production strategy can affect order volumes. And when a supplier becomes deeply connected to a large OEM program, the relationship becomes extremely valuable, but also strategically important to monitor. Yet there's a bigger reason why these risks matter now. TD Power is not merely experiencing higher demand. It is entering a phase where the scale of the opportunity itself is changing. The company is receiving repeat orders for United States data center applications. It has significant gas turbine programs with major global OEMs. It has won a large hydro order. It has received a 60 megawatt generator order, among the largest in that segment. And the company says further high-volume generator programs are indicated for the coming period. So the challenge is becoming increasingly clear. TD Power has to expand without losing control. It has to grow without allowing working capital to run ahead of cash generation. It has to increase capacity without destroying returns on capital. It has to protect margins while raw material costs move. It has to satisfy demanding global customers. And it has to maintain quality as volumes rise. This is why the current phase of the company is so interesting. The industry is providing a strong tailwind. But the tailwind alone will not create shareholder value. The company has to know how to use it. And TD Power has one advantage that may help. It has already spent decades building manufacturing and engineering capability. Its history shows technology relationships with companies such as Toyo Denki, Voith and Siemens, along with long-term relationships in gas engine generators and traction applications. That accumulated experience is now being tested at a much larger scale. And this is where the story begins to move beyond the simple idea of sector growth. Because something unusual is happening inside TD Power itself. The company is not merely receiving more orders. It is beginning to cross thresholds that it has never crossed before. A largest ever order here. A record order inflow there. A new customer application. A repeat global program. A larger machine. A new scale of exports. And eventually, a change in management's own expectations. Individually, each event is interesting. But when several of them appear together, they create a completely different question. Are these just a collection of successful contracts? Or are they evidence that TD Power is entering a new chapter in its evolution? That is where the next chapter becomes crucial. Because sometimes the most important signal in a company's history is not that it has grown. It is that it has done something for the first time. And when those firsts begin appearing one after another, they can reveal a change in the company's identity before the financial statements fully catch up. This is Story Behind Stocks, where the biggest changes in a company often begin quietly, one first at a time. The moments when TD Power crossed a threshold. This is Story Behind Stocks, where the most important changes in a company often begin with something that has never happened before. There is a strange psychological difference between a company doing something well and a company doing something for the first time. If a business earns more money than last year, that is growth. If it receives more orders than last year, that is growth. But when a company suddenly receives its largest order ever, enters a new application at meaningful scale, wins repeat business from a major global customer, and begins operating at a level it has never reached before, something else may be happening. The company may be changing its own definition of normal. And that is what makes TD Power particularly interesting right now. The first clue is order inflow. During the period, TD Power recorded its highest ever quarterly order inflow. The company received orders worth approximately 734 crore rupees, compared with around 392 crore rupees in the corresponding period. That represents growth of about 87%. But the number itself is not the most interesting part. The interesting part is what sits underneath it. Because these orders did not come from a single narrow opportunity. They came from several different parts of the business. And that makes the development much more significant. In the hydro generator business, TD Power secured what it describes as the segment's largest order. 4 vertical hydro generators, each with a capacity of 16 megawatts, for a major hydropower project in Africa. The company also won hydro orders from European and domestic OEMs for projects across Europe and India, covering machines in the 9 to 22 megawatt range. This matters because hydro is not a new theme invented for this particular period. TD Power has been developing vertical hydro generator capabilities for years. Its presentation traces the development of these generators back to its collaboration with Voith in Germany. So when the company now wins a very large hydro order, it is not entering an unfamiliar business. It is monetizing a capability it has been building for years. Then the story moves to gas engine generators. Here something even more interesting appears. TD Power secured large volume repeat orders from leading global OEMs for United States data center applications. The word repeat deserves attention. A first order tells us that a customer is willing to try the supplier. A repeat order tells us that something has already gone right. The product has performed. The relationship has worked. The customer is comfortable enough to come back. And now the company is talking about high volume programs. That is a very different stage of customer acceptance. The company also won an order from a domestic OEM for a machine of around 6 megawatts for India's largest LNG terminal. And management expects further high-volume generator programs in the following period. So the gas engine business is not simply receiving isolated orders. It appears to be developing standardized, higher-volume programs. The company's presentation specifically connects these programs with improving scale, operational efficiency, and capacity utilization. Capacity utilization simply means how much of the available factory capability is actually being used. If a factory can produce 100 units but is operating at only 50% utilization, there is unused capacity. If utilization rises, the company can potentially spread fixed costs across more production. That can improve economics. And this is where an order can become more than revenue. It can change how efficiently the factory operates. Then comes the gas turbine business. TD Power secured significant volume orders from a major global gas turbine OEM in the United States. These programs cover the 14 to 18 megawatt range and involve multiple projects. But the company also describes a strong expected order pipeline from a second major global OEM across the 12 to 19 megawatt range for United States programs. That is important because now we are no longer talking about one customer. There appears to be the possibility of multiple global OEM relationships developing simultaneously. And the applications extend beyond data centers. The company identifies data center expansion alongside oil and gas and industrial applications as demand drivers. This broadens the opportunity. The data center theme may be powerful, but it is not the entire story. TD Power can participate when gas generation is required for other industrial purposes as well. And that brings us to perhaps the most surprising number in this entire sequence. 93% of the company's order inflow came from exports. Approximately 684 crore rupees of the 734 crore rupee order inflow came from international markets. That means the current surge is not simply an Indian demand story. TD Power is increasingly participating in global programs. The order book at the end of June stood at roughly 2,207 crore rupees. So we have three different developments happening together. New records, larger individual orders, and increasing international participation. But there is one more threshold, perhaps the most important one. Management has increased its FY27 revenue guidance to 2,600 crore rupees. Guidance is management's current expectation of where the business can go based on its order pipeline, execution capability, and market conditions. It is not a guarantee. But when management raises guidance after experiencing stronger demand, the market naturally begins recalculating the company's future earning potential. And this is where all the earlier events begin connecting. The largest quarterly order inflow, the largest hydro order, repeat data center programs, large gas turbine programs, a second major OEM pipeline, very high export participation, a large order book, and higher management expectations. Any one of these could be dismissed as an isolated event. Together, they become harder to ignore because the company is crossing thresholds across different dimensions: product scale, customer scale, geographic scale, order scale, manufacturing utilization, and expected revenue scale. That is the moment when an investor should stop asking only, "How much did the company grow?" and start asking a more important question. Has the company's base level of business changed? Imagine a factory that used to receive orders worth 300 crore rupees every quarter. Then suddenly it starts receiving orders worth 700 crore rupees. If that happens once, it could be an exceptional quarter. If it happens repeatedly, the interpretation changes. The company itself says the current rate of order inflow has exceeded 700 crore rupees per quarter, and that it believes it is positioned to execute close to that rate. That statement is much more important than simply saying orders were strong, because management is effectively telling investors that the new level may not be temporary. But this is exactly where we need to remain disciplined. An order is not revenue. A revenue number is not cash. And a strong order book does not automatically guarantee high returns for shareholders. The company still has to manufacture. It still has to deliver. Customers still have to accept the equipment. Payments still have to arrive. And margins still have to survive the entire process. So these firsts are not the conclusion. They are evidence. Evidence that something may have changed. And that is what makes the next chapter so important. Because eventually the question moves away from orders. It moves from what customers have promised to buy to what TD Power can actually earn from those orders. That is the point where the story moves from possibility to economics. And if these new orders are truly changing the company's scale, the next thing we should see is not simply higher revenue. We should see the earnings engine itself becoming more powerful. This is story behind stocks, where a record becomes truly meaningful only when it changes what a company can earn tomorrow. When demand becomes an earnings engine. This is story behind stocks, where the real test of a business is not how many opportunities it discovers, but how efficiently it turns those opportunities into earnings. An order is exciting. A large order is even more exciting. But an order sitting inside an order book does not pay salaries, does not create profit, and does not return money to shareholders. Something has to happen between the moment a customer places an order and the moment TD Power reports earnings. Materials have to be purchased. The machine has to be engineered. Production capacity has to be allocated. The generator has to be manufactured. It has to be tested. It has to be delivered. Revenue has to be recognized. And eventually, the customer has to pay. That entire journey is what turns demand into an earnings engine. And this is where TD Power's recent story becomes much more interesting. Because the company isn't simply receiving more orders. Its financial performance suggests that those orders are beginning to translate into a significantly larger operating business. In the latest period, revenue reached roughly 640 crore rupees. That was an increase of more than 70% compared with the corresponding period. Operating earnings before interest, tax, depreciation and certain accounting adjustments, commonly called EBITDA, rose at a similar pace. And profit after tax also increased by roughly 72%. At first glance, these are simply impressive growth numbers. But look more closely. There is a subtle quality to this growth. Revenue is growing rapidly. Operating profit is growing rapidly. And net profit is growing rapidly. The three are moving together. That matters. Because there are many ways a company can produce impressive revenue growth. It can reduce prices. It can accept lower margins. It can take on low-quality business. It can stretch working capital. It can even report strong accounting profits while cash generation remains weak. TD Power's recent numbers suggest something different. The business is scaling while maintaining an operating margin around the high teens. That means the company is not simply buying revenue at any cost. It is retaining a meaningful portion of that additional revenue as operating profit. And to understand why that matters, we need to look backwards. Because the transformation did not begin with the latest period. Over the last several years, TD Power has gradually moved from a much smaller revenue base into a substantially larger business. Revenue increased from around 800 crore rupees in FY22 to more than 1800 crore rupees in FY26. At the same time, operating profit increased from roughly 97 crore rupees to more than 300 crore rupees. Operating margins moved from around 12% to roughly 18%. That is a significant change. The company has not merely grown. It has become more profitable as it has grown. And that is where a concept called operating leverage becomes important. Operating leverage simply means that some costs of running a business do not increase at the same speed as revenue. Imagine a factory that has the capacity to produce a certain number of generators. The factory, engineering team, and many other costs exist even when production is lower. If production rises substantially, those existing costs can be spread across more units. The additional revenue can therefore produce a disproportionately larger increase in operating profit. That is the opportunity. But there is another side. If demand falls, those fixed costs do not disappear immediately. So the same structure that can amplify profits during expansion can amplify the pain during a downturn. This is why the quality and durability of TD Power's current demand matters so much. If the recent order acceleration is temporary, the market may be looking at a short period of unusually high utilization. But if the new order environment continues, the company could be operating at a structurally higher level of capacity utilization. And that could change the economics of the business. This is one reason the company's current order pipeline deserves attention. Management says order inflow has crossed 700 crore rupees per quarter, and that the company believes it is positioned to execute close to that inflow rate. The implication is powerful. If orders continue arriving at this pace, the company is not simply filling the factory for a few months. It could be creating a much larger production base. And this is where the order book becomes important. An order book is essentially the value of business already won, but not yet recognized as revenue. It provides some visibility into future business. TD Power's order book stood at roughly 2,200 crore rupees at the end of June. But even that number needs to be interpreted carefully. An order book is not guaranteed profit. Some orders may take longer to execute. Some may require substantial working capital. Some may have different margins. And some may be recognized over a longer period. So the quality of an order book matters just as much as its size. In TD Power's case, one encouraging factor is the nature of some of the recent orders. The company is not only receiving one-off projects, it is seeing repeat business. The gas engine business, for example, has received large volume repeat orders from leading global OEMs for United States data center applications. The gas turbine business has received significant volume orders from a major global OEM and expects a substantial pipeline from another major global OEM. The steam turbine business has received orders across industrial applications and export markets. The hydro business has secured a very large order. This diversity matters because it reduces the risk that the entire growth story depends on one individual program. And there is another interesting development. Some of these programs are becoming standardized and high volume. Standardization means the company is producing machines according to repeatable specifications rather than reinventing the entire engineering process for every individual customer. That can improve manufacturing efficiency. It can improve planning. It can improve utilization. And potentially, it can improve margins. The company itself points to improving scale, operational efficiency, and capacity utilization in its high-volume gas engine programs. This is where the story becomes much more than a simple order growth narrative. The real opportunity is a chain reaction. More orders can lead to higher production. Higher production can lead to better utilization. Better utilization can improve operating efficiency. Higher operating efficiency can support margins. Higher margins on a larger revenue base can accelerate profit. And if that profit eventually converts into cash, the company gets the financial flexibility to invest further. That is how an industrial business can move from growth to compounding. But there's a crucial word in that sentence. Eventually, because profit and cash are not the same thing. And this is one area where investors need to remain patient and disciplined. A fast-growing manufacturer can have excellent reported earnings while simultaneously investing more money into inventory and receivables. Inventory is the material and finished equipment waiting to be used or sold. Receivables are money owed by customers after the company has recognized the sale. Both are normal, but if they rise much faster than revenue, the business can start consuming cash. So the next stage of TD Power's evolution is not simply about producing more. It is about producing more efficiently, selling more profitably, and collecting the money. That is why the balance sheet deserves as much attention as the profit and loss statement. The company's very low debt position provides an important cushion. It means the business is not currently relying heavily on borrowing to finance its operations. But low debt does not eliminate the need for working capital. A company growing this quickly still needs money to fund its expansion. And this is where management's execution becomes critical. The company has effectively told the market that demand is no longer the biggest concern. The challenge is execution. Can TD Power manufacture fast enough? Can it maintain quality? Can it deliver on time? Can it protect margins? Can it manage inventory? Can it collect receivables? Can it expand capacity without overinvesting? And can it do all of this while maintaining the relationships that are bringing these global orders? Those questions will determine whether the current growth becomes structural. There is another number that raises the stakes. Management has upgraded FY27 revenue guidance to 2,600 crore rupees. That is a significant step above the previous financial year's revenue. And because the current order inflow rate is already above 700 crore rupees per quarter, the guidance is not appearing out of nowhere. Management is seeing enough demand and enough execution visibility to raise its expectation. But this also creates a new responsibility. Once management raises guidance, the market starts measuring the company against that new benchmark. The company has effectively raised the bar for itself. And this is where the story changes again. Until now, we have been asking whether TD Power has enough demand. The evidence increasingly says yes. We have asked whether it can manufacture and execute that demand. The company says it is positioned to do so. Now there is a much harder question. How much should investors pay for a company whose earnings may be entering a new growth phase? Because a business can become dramatically better and still produce poor shareholder returns if investors pay too much for that improvement. That is where TD Power enters the most difficult part of its story. The market has already recognized that something is changing. The stock is no longer being valued like an ordinary electrical equipment manufacturer. Investors are paying for future earnings. They are paying for the possibility that today's order acceleration becomes tomorrow's normal revenue base. And they are paying for the possibility that the company can sustain high growth for several years. So now we have to step away from the factory for a moment. We have followed the orders. We have followed the production. We have followed the earnings. And we have seen the engine beginning to accelerate. But if the market is already anticipating that acceleration, the next question becomes unavoidable. How much of TD Power's future is already reflected in today's valuation? Because that is where a good business can become a difficult investment. This is story behind stocks, where the difference between a great company and a great investment is often hidden in the gap between what the business can become and what the market is already expecting. The future is already being priced. This is story behind stocks, where a great business can still become a difficult investment when the market starts paying for tomorrow before tomorrow arrives. TD Power has reached an interesting point in its journey. The business is growing rapidly. Orders are expanding. Profitability has improved. The international opportunity is becoming larger. Data center-related demand is becoming visible through actual customer orders. Gas turbine programs are expanding. Management has raised its expectations for the year, and the market has noticed. That last part is crucial, because the stock market does not value a company only on what it earned yesterday. It constantly tries to estimate what the company might earn tomorrow. And when investors become convinced that tomorrow will be much better than today, they are willing to pay a premium. TD Power is already trading at such a premium. The company's price-to-earnings ratio is around the mid-80s based on the figures we have been analyzing. Price-to-earnings, or PE, simply tells us how much investors are paying for every rupee of annual profit. If a company earns 100 rupees and investors value it at 20 times earnings, the market is effectively valuing that earnings stream at 2,000 rupees. If another company is valued at 80 times earnings, the market is demanding much more from its future. And that is where TD Power becomes interesting. An 80 times earnings valuation is not necessarily irrational, but it leaves very little room for disappointment. The market is effectively saying that the profits of this company are likely to be substantially larger in the future than they are today. And there is evidence supporting that expectation. Revenue has grown strongly. Margins have expanded. Order inflow has accelerated. Management has upgraded FY27 revenue guidance to 2,600 crore rupees. So we cannot simply look at the PE ratio and conclude that the stock is expensive and stop there. That would be too simplistic. The more important question is whether the earnings growth can continue quickly enough to make today's valuation progressively more reasonable. This is where the PEG ratio becomes useful. PEG compares the price to earnings multiple with the expected rate of earnings growth. In simple terms, it asks whether investors are paying a reasonable premium for the speed at which profits are expected to grow. TD Power's PEG ratio is above to based on the figures we have been analyzing. That does not suggest a bargain. It tells us something else. The market is already paying heavily for growth. Therefore, future earnings cannot merely grow. They need to grow strongly enough to justify the premium. And this is where valuation becomes less about one ratio and more about a series of questions. What happens to revenue over the next 3 years? What happens to margins? How much additional capital will the company need? How much cash will those earnings generate? How long can the growth continue? And how much of that growth is already reflected in the current market valuation? That is why looking at only PE is insufficient. Another useful measure is price to book value. Book value is the accounting value of the company's net assets after subtracting liabilities from assets. TD Power trades at a substantial premium to its book value. At first glance, that looks uncomfortable. But there is an important limitation. Book value captures physical assets reasonably well. It does not fully capture engineering know-how. It does not fully capture customer relationships. It does not fully capture technology partnerships. It does not fully capture product qualification with global customers. And it certainly does not neatly capture decades of experience accumulated by engineers and manufacturing teams. For a specialized engineering company, these intangible capabilities can be economically valuable even when they don't appear as large assets on the balance sheet. That brings us to another way of thinking about valuation. Replacement value. Imagine someone wanted to recreate TD Power from scratch. They would need factories. They would need machinery. They would need engineers. They would need manufacturing processes. They would need technology. They would need customer approvals. They would need relationships with global OEMs. They would need a track record. And they would need years of experience. The cost of reproducing the entire operating capability could be very different from the accounting value of the asset shown on the balance sheet. But this argument has to be used carefully. It does not mean that every company with specialized assets deserves an unlimited valuation. The market ultimately pays for economic returns. And that leads us to an even more conservative concept: earnings power value. The idea is simple. Instead of assuming spectacular growth forever, ask what the existing business could reasonably earn if its current competitive position remained broadly intact. That question is particularly useful for TD Power, because if the company can justify a significant portion of its valuation using its existing earning capability, then future growth becomes an additional opportunity. But if almost the entire valuation depends on years of exceptional growth, then the margin of safety becomes much smaller. This is where discounted cash flow analysis becomes useful. A discounted cash flow model, or DCF, essentially asks what all the future cash generated by a business is worth today. The further into the future the cash arrives, the less valuable it is today because the future is uncertain. So a DCF does not simply ask whether TD Power can grow. It asks how much it can grow, how long it can maintain that growth, how profitable that growth will be, how much capital will be required, and how much cash will ultimately reach shareholders. And this is where the TD Power story becomes sensitive. Suppose the company grows rapidly for several years. Margins remain healthy. The data center opportunity continues. Gas turbine programs expand. Export orders remain strong. Working capital remains under control. And operating cash flow catches up with reported profits. In that scenario, today's valuation can gradually become more reasonable. Not because the share price necessarily falls, but because the earnings underneath the valuation become much larger. That is the important distinction. A stock can remain at a high PE while actually becoming cheaper relative to its future earnings. But the opposite is also true. If growth slows significantly while investors continue paying a high multiple, the valuation can become vulnerable very quickly. This is why historical valuation matters. Where did TD Power trade in previous years? What valuation did investors assign before the current growth acceleration? And more importantly, what changed between then and now? If the business has genuinely changed, comparing today's multiple mechanically with an old multiple can be misleading. But if the valuation has expanded much faster than the underlying economics of the business, that deserves caution. Relative valuation gives us another perspective. TD Power operates within the electrical equipment and capital goods ecosystem. Other companies in the sector also benefit from power infrastructure investment. Some have much larger scale. Some have higher margins. Some have stronger balance sheets. Some have different product portfolios. So TD Power's premium needs to be justified by something. That something could be faster growth, better return on capital, stronger order visibility, higher export opportunity, better margin potential, or some combination of all of them. But there's another valuation test that I consider especially important for TD Power: cash flow. Because ultimately, accounting profit is an estimate of economic performance. Cash is what actually arrives. A company can report excellent profits while increasing its inventory and receivables. That does not necessarily mean the profits are poor. It may simply mean the company is financing growth. But eventually, the cash has to arrive. This becomes particularly important for TD Power because the company is growing rapidly. More orders require more inventory. More production can create more receivables. More capacity can require more capital expenditure. So the market needs to see something very specific. Revenue should rise. Profit should rise. And over time, operating cash flow should rise alongside them. If those three things converge, the quality of the growth becomes much stronger. And this is where valuation becomes much more interesting. Because we are not looking for a company that is absolutely cheap. We are looking for something much harder to find. A company where improving earnings, expanding opportunity, improving business quality, and strong market recognition are beginning to converge. That is the type of situation where a premium valuation can sometimes remain justified. But it creates a new responsibility for the company. TD Power cannot simply remain good. It has to keep becoming better. The market has already given it a premium. Now the company has to earn that premium. It needs to execute the large order pipeline. It needs to deliver the 2,600 crore rupee FY27 guidance. It needs to protect margins. It needs to manage working capital. It needs to convert accounting earnings into cash. It needs to turn data center opportunities into repeat programs. It needs to expand gas turbine business. And it needs to keep developing larger and more technically demanding products. In other words, the company has reached a stage where the valuation itself becomes part of the story. The market has already moved ahead of the present. Now the business has to catch up with the future that investors are pricing in. And there is one more fascinating clue. When investors pay a premium for a company, the stock usually begins behaving differently from the broader market. It starts attracting larger pools of capital. Its trading activity changes. Its long-term trend changes. And when fundamental acceleration and price behavior begin moving together, we get another independent piece of evidence. That is where the story moves next. Because the question is no longer only what TD Power is worth. It is whether the market itself is beginning to behave as though it believes TD Power is becoming a different company. This is story behind stocks, where valuation tells us what the market expects, but the market's own behavior tells us how strongly it believes that expectation. When the market changes its mind. This is story behind stocks, where the chart is not treated as a prediction machine, but as a record of how investors are changing their expectations about a business. There is a point in every company's journey when the market begins to see it differently. The business may have been improving for years. Management may have been executing. Customers may have been increasing. Orders may have been growing. But the stock can remain relatively quiet until investors collectively decide that the future is going to look different from the past. That moment is important. Because the stock market is ultimately a marketplace of expectations. Today's price reflects what investors believe about tomorrow. And TD Power's recent price behavior suggests that the market has dramatically changed its expectations. Look at the longer history of the stock. For years, TD Power was not a stock that commanded the kind of attention it receives today. Its business was growing, but the market's recognition was gradual. Then something changed. The stock entered a much stronger long-term uptrend. An uptrend simply means that investors are consistently willing to pay higher prices over time because their expectations about the company's future are improving. But a strong uptrend alone does not tell us why the market is becoming optimistic. Are investors actually recognizing that change? When both begin pointing in the same direction, the signal becomes much more interesting. One of the most important developments in TD Power's chart has been its movement into price territory, where the stock had previously struggled to remain. This is commonly called a breakout. A breakout simply means that buyers have pushed the stock beyond an area where sellers repeatedly stopped it in the past. Think about what happens psychologically. Imagine investors bought the stock earlier and then watched it fall. They remember that experience. When the price approaches that old area again, Some investors are tempted to sell simply because they finally have an opportunity to exit. That creates resistance. But if the company continues producing better numbers and new investors become more optimistic, eventually the demand can become strong enough to absorb that selling. When price moves through that barrier, the market is effectively saying something has changed. The old valuation framework may no longer be sufficient. And TD Power has experienced exactly this kind of transition. But there's another clue that makes the move more meaningful. Volume. Volume simply tells us how many shares are changing hands. A price increase on ordinary trading activity can sometimes be fragile. But when a major move is accompanied by unusually high volume, it suggests that a much larger group of investors is participating. That does not guarantee that the move will continue. But it tells us that the market is taking the move seriously. And this is particularly important in TD Power because the stock's price expansion has occurred alongside a major improvement in the company's operating performance. The chart is not moving in isolation. The business is providing reasons for investors to change their expectations. Record order inflow, record quarterly sales, strong profit growth, large international programs, repeat orders from global OEMs, data center exposure, gas turbine opportunities, a growing order book, higher management guidance, and at the same time, the stock is moving into a much stronger phase of price discovery. That convergence is what makes the situation unusual. Because sometimes a stock rises before the fundamentals improve. Sometimes the business improves, but the market ignores it. And sometimes both happen together. When the third situation occurs, the market can revalue a company very quickly. Revaluation simply means investors become willing to pay a different multiple for the same rupee of earnings because they now believe the future earnings will be much larger or more durable. That is exactly what appears to have happened with TD Power. The market is no longer valuing the company purely on what it earned several years ago. It is increasingly valuing the possibility of what the company can earn several years from now. And this helps explain why the stock's long-term performance has become so powerful. But there is a danger here. A strong chart can create its own psychology. When a stock rises dramatically, more investors notice it. When more investors notice it, more people want to participate. When more people participate, the price can rise further. That can create a feedback loop. The rising price attracts attention. Attention attracts buyers. Buyers push the price higher. The higher price attracts even more attention. This is one reason strong stocks can sometimes move much faster than their underlying earnings. And that is where an investor has to remain careful. A powerful trend does not mean every price is a good price. It simply means the market currently has strong conviction. And conviction can change. This is particularly important for TD Power because the valuation we discussed in the previous chapter is already demanding. The market is not buying this company as an overlooked industrial stock anymore. It is buying a growth story. That means the technical picture has to be interpreted alongside the valuation. If earnings continue accelerating, the trend can remain supported because the fundamental value underneath the price keeps increasing. But if earnings growth slows sharply, the same technical structure can become vulnerable because expectations have become elevated. This is why the combination of fundamentals and price behavior is so important. Neither one should be treated independently. Imagine the business is improving, but the stock is falling. That would tell us the market may be questioning the durability of the improvement. Now imagine the stock is rising, but earnings are deteriorating. That would tell us the market may be getting ahead of reality. But when earnings, orders, management expectations, and price behavior all improve together, the interpretation is different. The market is effectively confirming the business story. And TD Power has another interesting element in this equation: institutional ownership. Institutions are large professional investors such as mutual funds, insurance companies, and other investment organizations. Their participation does not automatically make a stock safe. But sustained institutional participation can matter because these investors typically have larger research teams, longer investment horizons, and the ability to deploy substantial capital. TD Power's shareholding data shows a significant increase in foreign institutional ownership over the period, while domestic institutional ownership has also remained substantial. That tells us the market's interest is not coming only from small individual investors. Professional capital has increasingly become part of the shareholder base. Again, this is not proof that the stock must rise. It is evidence that the company is attracting a broader class of investors. And that brings us to the most important insight from the chart. The technical structure is not telling us that TD Power is guaranteed to continue rising. It is telling us that investors have already begun repricing the company's future. That distinction is critical. A chart cannot tell us whether the future earnings will actually arrive. It can only show us that the market believes they might. The responsibility now moves back to the business. The company has raised guidance. The order book is strong. The global opportunity is expanding. The stock has already responded. Now the next few periods become a test. Can the company continue converting orders into revenue? Can revenue continue growing rapidly? Can margins remain healthy? Can cash flow catch up with earnings? Can the new customer relationships turn into sustained programs? And can the company keep expanding without destroying the economics that made investors excited in the first place? Because once a company reaches this stage, the market stops rewarding it merely for having potential. The market begins demanding proof. And this is perhaps the most important transition in the entire TD Power story. A few years ago, investors could have asked, could TD Power become a much larger company? Today, that question is becoming less speculative. The company itself is talking about a much larger revenue base. The order inflow is already operating at a much higher level. Global customers are increasing their engagement, and the market is pricing in a significant part of that future. So the question has changed. It is no longer, can TD Power surprise the market? It is, can TD Power deliver enough to justify what the market already believes? That is a much harder test. Because when expectations are low, merely doing well can create a surprise. When expectations are high, even doing well may not be enough. The company has to do better than the expectations embedded in the price. And that takes us directly to the next chapter. Because management has now given the market something very specific to judge. A higher revenue ambition, a stronger growth expectation, and a promise implicit in that guidance that the company's new level of demand can actually be converted into business. The market has voted. Now management has to deliver. This is story behind stocks, where the chart can reveal when the market changes its mind, but only business performance can prove whether that new belief was justified. The management has raised the bar. This is story behind stocks, where every ambitious business story eventually reaches the same moment when management has to turn confidence into measurable performance. Until now, we have been looking at what has already happened. The industry is changing. The opportunity is expanding. TD Power is winning larger orders. Customers are returning with repeat business. Exports are becoming more important. Profitability has improved. The stock market has recognized the change. But there is a point where a company's past performance stops being enough. That point arrives when management tells investors what it believes the future can look like. And TD Power has now raised that expectation. The company has upgraded its FY27 revenue guidance to around 2,600 crore rupees. Guidance is simply management's estimate of what the business can reasonably achieve based on its current visibility into demand, orders, and execution. It is not a guarantee. It is a target against which the company will eventually be judged. And that distinction matters enormously. Because once management raises guidance, the market begins looking at every subsequent period through that new lens. If the company delivers, confidence increases. If it consistently exceeds expectations, the market may become even more optimistic. But if it misses, the reaction can be very different. That is why guidance is not just a number. It is a commitment of expectations. And TD Power's guidance becomes particularly interesting when we look at what is happening underneath it. Management says the current rate of order inflow has crossed 700 crore rupees per quarter. The company believes it is positioned to execute close to that level of order inflow. That is a significant statement. Because if the business can sustain an order inflow rate of that magnitude, the question is no longer whether TD Power has enough demand. The question becomes whether it can build an organization capable of handling that demand efficiently. That changes the nature of the challenge. A few years ago, growth would have required finding more customers. Today, the company increasingly needs to manage scale. And managing scale is a completely different skill. Imagine a restaurant that suddenly becomes the most popular restaurant in the city. More customers sounds wonderful. But if the kitchen cannot handle them, service deteriorates. If ingredients run out, customers become unhappy. If staff are overwhelmed, quality falls. If the owner expands too quickly, costs rise. The same principle applies to manufacturing. More orders are valuable only when the company has the capacity to fulfill them without damaging quality, margins, or cash flow. TD Power appears to understand this. Management has spoken about capacity expansion and execution. The company has also indicated that it is working to increase production capability across its generator businesses. This is important because some of the opportunities emerging now are considerably larger than the company's historical base. The hydro business is receiving larger orders. The gas engine business is seeing repeat high-volume programs. The gas turbine business is seeing significant volume orders. And data center-related demand is becoming increasingly important. Each of these requires manufacturing capacity. But capacity does not simply mean building another factory. It means having the right machines, the right engineers, the right suppliers, the right production processes, the right quality systems, and enough working capital to support the increased volume. This is why management's next challenge is more complex than simply increasing revenue. The company has to grow while protecting the economics of the business. And that brings us back to margins. TD Power's operating margin has improved substantially over the years and currently sits around the high teens. Maintaining that level becomes important because rapid revenue growth is not necessarily valuable if every additional rupee of sales produces progressively less profit. The market is therefore watching two things simultaneously. How quickly can TD Power grow? And how much of that growth can it retain as profit? That second question is particularly important because raw material costs can change. Copper and other inputs can become more expensive. Logistics costs can move. Currency movements can affect exports. And large customers can have significant negotiating power. Management has indicated that commodity prices remain an area it is watching closely, while expecting margins to remain broadly stable over the near term. That tells us something useful. Management is not assuming that every increase in revenue automatically becomes higher profit. It understands that the economics have to be protected. And that is precisely what investors should want to see. Because a premium valuation can survive temporary fluctuations. What it cannot survive indefinitely is structural deterioration in profitability. There is another part of management's guidance that deserves attention. The company has indicated that the current order environment is strong enough to support the FY27 revenue ambition. But management has also discussed the longer-term opportunity extending beyond the immediate year. That is where the story becomes more interesting. Because the current opportunity is not based on one large project. There are several potential engines: data centers, gas turbines, hydro, industrial applications, export markets, large global OEM programs, and potentially larger generator applications. This gives the company multiple avenues for growth. But it also makes execution more complicated. Different customers have different specifications. Different markets have different regulations. Different products require different engineering capabilities. And international projects have different delivery schedules. So management has to coordinate all of these moving parts without allowing complexity to overwhelm the organization. This is where the experience of the leadership team becomes important. The company's senior management has decades of experience across rotating electrical machines, power generation, manufacturing, and international business. That does not guarantee successful execution, but it does mean the people responsible for managing this expansion are not learning the industry from scratch. They have lived through different cycles. They have seen periods of weak demand. They have seen commodity inflation. They have managed manufacturing. They have worked with global customers. And now they are being asked to manage a period of unusually strong demand. That is a very different challenge. There is another number that tells us why this challenge is becoming urgent. The order book is already around 2,200 crore rupees. That represents business already won but not yet recognized as revenue. So the company has significant visibility. But visibility is not the same as certainty. The order still needs to be manufactured. It still needs to be delivered. The customer still needs to accept it. And the company still needs to collect the money. That is why execution will become one of the most important themes in the TD Power story. The market is no longer asking whether the company can win orders. It has demonstrated that. The market is increasingly asking whether it can fulfill those orders at the expected speed and profitability. That is a much higher standard. And there is another reason management's guidance matters. The company's valuation is already demanding. Investors are paying a premium because they believe earnings will grow strongly. Therefore, simply achieving normal growth may not be enough. TD Power needs to demonstrate that the elevated expectations are justified. If management delivers the 2,600 crore rupee revenue ambition while maintaining healthy margins and improving cash generation, the valuation becomes easier to defend. The earnings underneath the stock price become larger. But if the company achieves strong revenue growth while margins weaken or working capital absorbs most of the additional profit, the quality of the growth becomes less impressive. That is why the next phase has to be judged on more than revenue. We need to watch the entire chain. Orders, revenue, margins, profit, cash flow, capacity, working capital, and customer repeatability. The most powerful version of the TD Power story is not one in which the company gets one spectacular year. It is one in which the company establishes a higher base and then compounds from that new base. That would mean the current order inflow is not merely a peak. It becomes the beginning of a new normal. And that is the central question management now has to answer. Can today's extraordinary demand become tomorrow's ordinary business? Because if it can, the implications are substantial. A larger revenue base, higher factory utilization, greater operating efficiency, stronger customer relationships, more international exposure, higher earnings, and potentially greater cash generation. But if demand turns out to be temporary, the market may eventually discover that it paid for a future that arrived only briefly. That is why guidance is so important at this stage. Management has effectively raised the bar. The market has already priced in a meaningful part of the opportunity. Now the company has to demonstrate that the opportunity is real, repeatable, and profitable. And perhaps the most fascinating part is that the immediate opportunity may not even represent the full potential market available to TD Power. Because behind these orders is something much larger. A world that is investing heavily in electricity infrastructure. A world where data centers are only one part of the demand equation. A world where gas generation, hydro, industrial power, and grid reliability may all require new equipment. And that takes us to the next question. How large could the opportunity actually become if TD Power continues winning these programs and moves into larger and more demanding applications? Because sometimes the biggest part of a company's growth story is not what has already entered the order book. It is the market that sits just beyond it. This is story behind stocks, where management can set the direction, but only repeated execution can turn a promising opportunity into a durable growth story. Top of form, bottom of form.